Good evening, I'm Mike Knetter. Welcome to the UW Now live stream, where we bring you timely and important topics. As inflation continues to rise, now surpassing 7% year on year, its impact is cascading through the economy. How is it affecting the labor market and wages? What policy actions can be taken to reduce inflation? Can we reduce inflation without jeopardizing the ongoing recovery in employment and output? How are inflation and the Federal Reserve's anticipated actions impacting stock markets and the value of the US dollar? And what actions can consumers, investors, and businesses take to deal with inflation pressures in the short and long run? Joining us tonight, we've got three experts from the UW community. Kim Ruhl is the Mary Sue and Mike Shannon Distinguished Chair in Economics and the Associate Director of the Center for Research on the Wisconsin Economy. Mike Stohler is the Chief Investment Officer of the Wisconsin Foundation and Alumni Association. And Brad Tank is the Chief Investment Officer and Managing Director at Neuberger Berman Funds. Thank you for joining us this evening, and kicking us off tonight to give us an update on current economic trends will be Professor Kim Ruhl. As noted, he's the Mary Sue and Mike Shannon Distinguished Chair in Economics and Associate Director of the Center for Research on the Wisconsin Economy. Kim's research focuses on international economics, models of firm heterogeneity, and national income accounting. He is currently a research associate at the National Bureau of Economic Research and a special sworn employee of the U.S. Bureau of Economic Analysis, where he studies the ways that multinational firms produce and sell goods and services around the world. Kim, thanks for taking the time to join us this evening. I know you went the extra mile to really pull together some materials to set the foundation for tonight's discussion. So I'll turn it over to you. Thank you.
Great. Thanks, Mike. So what I'd like to do today is lay some groundwork and show you a bit about what's going on right now, and then get out of the way and let the market experts talk about what they think the market is going to do in response to what's happening to inflation and what the Fed might do. So next slide, please. Just to get started and to set some ideas, I'm going to start by talking a little bit about the link between inflation and stock prices, which is kind of what we're after today. And that in between that link is that the Fed is sitting there and its behavior with interest rates. So I talk through briefly about how the Fed sees inflation and why the Fed's actions will affect stock prices. Current inflation rates, I'm going to talk about a little bit of data. As many of you probably already know, they're historically high, at least relatively historically high, and broad-based. We're seeing kind of inflation throughout the economy. I'll show you a little bit of stuff on that. And then talk a little bit about maybe what we might see in terms of future monetary policy, which are certainly going to take the form of higher interest rates. It's going to leave open a lot of questions in terms of how high do we think interest rates will go and kind of how quickly. I think there's still a lot of uncertainty around some of that. Classic questions like, well, as we raise interest rates, will we see a recession? Maybe, probably. If so, how severe? And then how will the interest rate prices kind of move into equity prices? So that's kind of what I want to do before we let everybody else take over. Okay, so maybe just a very simple model of what we're talking about today is inflation. And, inflation is just a kind of sustained increase in the price level. So think about just an average price of goods and services in the United States. As that rises, we call that inflation. The link kind of between inflation and then interest rates, sort of in this very simple way, is the Fed. So the Federal Reserve sort of looks at inflation rates and adjusts interest rates in response to that. And we'll go through in the next couple slides sort of how they think about that problem. And then interest rates have an effect on stock prices through financial markets. And that kind of red arrow that says markets underneath it is largely what I'd like to leave up to our professionals. Next slide, please. Okay, so let's start by thinking about that first arrow, the Fed's dilemma, as it's put. So we think about the Fed as having a dual mandate. In fact, that's sort of right in the legislation that created the Federal Reserve. And so they're sort of tasked with doing two things by giving the economy low, predictable inflation, so keeping prices kind of stable, and full employment. And maybe a looser way of saying it is to fight recession, so to keep the economy from becoming too negative and to keep employment high. Now, those two goals are typically at odds with each other. So we think about the first one, inflation tends to grow, it tends to speed up when the economy is doing really well and employment is low. And so when the Fed then wants to ease back on inflation by increasing interest rates, it's likely going to increase unemployment, decrease employment, and kind of maybe even put the economy in a recession. And so we call that the Fed's dilemma, that it would like to kind of keep both inflation low and employment high, but oftentimes it can't do that. It's going to kind of have to prioritize one or the other. Now, as I mentioned, the Fed's tool to kind of help it move between these two different goals that it has are interest rates. Now I'm going to talk about interest rates very broadly. The Fed controls a very narrow, very short-term interest rate. And I'll talk a little bit about how that translates into other kinds of interest rates. And there are also other tools that the Fed has at its disposal. But today, we only have a few minutes to talk about this. I'm just going to say interest rate. And so if the Fed is raising the interest rate, that's a kind of contractionary policy. And that's going to kind of slow down economic growth and tend to ease inflation. So if inflation is high, you want to raise interest rates. That's going to be contractionary and kind of work towards that. Now, if I'm raising interest rates, like I say, it's contractionary, that's also going to lower employment. And so you would like to then lower interest rates to kind of keep the economy going and keep employment high. And so that's kind of the lever, if you will, that the Fed is sort of moving back and forth. Is sort of dialing interest rates to try to either decrease inflation or increase employment. Next slide, please. So briefly then, if the Fed is in some sense controlling interest rates, how do those move into stock prices? Well, that tends to happen through financial markets. So you want to think about it very broadly and simply, again, think about ways to save. So you have $1, you'd like to save it, have more than $1 in the future, hopefully, to spend. So one thing you could do is you could lend money to people or businesses. Typically, say something like buying bonds, right? And so that's very sensitive to the interest rate. And other thing you could do, or one of the things you could do, would be to buy shares of firms, equities, right? And then typically, stocks. And so you think about, in a very simple world, savers can either hold bonds and stocks, and they probably hold both. They're a mixed portfolio of the two. When interest rates rise, lending starts to become more profitable, right? And so on the margin, that's going to make stocks become sort of less interesting, and people are going to move away from stocks, and that's going to lower stock prices. So typically, not always, it's always a little bit more complicated than that, but higher interest rates tend to lower stock prices. Obviously, the more sort of volatility there is in the way people are viewing interest rates, more volatile stock prices are, but that's kind of a sort of bird's eye view of the situation. Next slide, please. So the last little bit of theory to think about is the markets and expectations. So think about, again, I mentioned, stocks and bonds are about saving. They're about doing something today with an expectation of what's going to happen tomorrow. And so these are savings decisions, they're forward-looking decisions. So the idea being that if I think something's going to happen in the future, I'm going to respond to it today. Imagine you want to sell your house, and you know that a year from now, the value of your house is going to fall. Well, then you'd like to sell your house today. And if everybody's thinking the same way, and they all kind of want to start selling their houses, that's going to start lowering the price of houses even today. And so what we see very often is that it's not just what the Fed is going to do today with interest rates, but it's what's happening in the future that the Fed is going to do. And so that makes expectations another tool that the Fed has. And it's one that in the last 30 years has become kind of more important, right? That the Fed has become much more careful about trying to give guidance as a way to set expectations on how future economic conditions and future interest rate policy is going to move. An example of kind of how these things can kind of move around is just with very recent history. So the Federal Open Markets Committee, the group that's kind of in charge of setting this policy rate, when they were making predictions about what they thought this policy rate, this interest rate was going to be for 2022, about a year ago, in March 2021, they thought the interest rate was going to be 0.1%. Reflecting basically what they thought was that the economy was still kind of in a low state. They wanted to boost employment and output, and they weren't too worried about inflation. So that is, we can keep interest rates low and attempt to help the economy recover because we're not too worried about inflation. As 2021 kind of goes on, inflation starts to pick up. The Fed starts to become more concerned about this. Their forecasts at the end of last year, so just 2 months ago, were up to almost 1%. So you're seeing about a 9 times increase in the projected interest rates for next year. And that's going to have, or this year now, and that's going to have an impact on future decisions. Next slide, please. So here's where you can see these impacts. So I'm just showing you quickly interest rates on a 10-year bond and a 2-year bond. And then the blue line is the Fed funds rate. That's the policy rate that the Fed controls directly. So you can see at the beginning of COVID and the beginning of kind of March of 20, the Fed, reacting to the economic problems, lowers their policy rate basically to almost zero very quickly. And with it, the 10-year and 2-year interest rates both come down as well. And if you just kind of focus on the 2-year interest rate, you see that stays low for most of 2020 and 2021, because if you think about a 2-year interest rate as a projection of what's going to happen in the future, right? And so you think 2 years from now, interest rates are still going to be low, then the 2-year interest rate is going to stay low. Now, you notice that as we get towards the end of October, the Fed funds rate, the policy rate hasn't changed yet, but expectations are changing. People are thinking interest is picking up, or inflation is picking up. The Fed's going to have to increase interest rates in the short term. So that now starts to get built into the 2-year rate. Right? And so in the same sense, the same thing is happening in the 10-year rate, but just 10 years is a lot further out. And so on average, what's happening today has a bit less of an impact, but you can still see much of the same pattern. And so this is how a very short-term interest rate like the Fed funds rate works its way through to longer interest rates, which are the ones that kind of matter for economic decisions. Next slide, please. Great. So now let me just give you a quick sense of what's going on before we turn it over to our market experts. So here's a measure of the inflation rate. So this is calculated using the consumer price index. And you see at the end here that inflation looks very high. It's about 7%, 7.5% in the most recent number there. And it hasn't been that high since somewhere in the early 1980s. And then we see that there were these two very large inflationary periods in the mid 70s and early 80s that the Fed under Paul Volcker had to work very hard to sort of get down. We had deep recessions surrounding those 2 points as we sort of brought inflation down. And then inflation has stayed down really since about 1985 at manageable levels. And so this is a bit kind of not unprecedented, but certainly central bankers today, probably haven't had to grapple with inflation of this kind of magnitude in the United States. Next slide, please. So here's just a very quickly, it doesn't necessarily have to be that national inflation rates, which is what I just showed you, are the same. The black line here is the inflation rate for the East, North, Central, Midwest, which covers Wisconsin. And you see it moves about the same. Inflation is actually a little bit higher typically in the Midwest than it is nationally, but moves kind of very similar. Next slide, please. If we look across sectors, there's some interesting differences. So the red line there again is still the aggregate price level for all goods. And here I'm just broken out a couple of interesting sectors. So if you look at transportation, which includes motor vehicles and includes gasoline and things, and you look at apparel, clothing, both of those things have negative inflation rates. Prices are falling at the onset of the recession. Everybody's staying home. They have no place to go. And so they're not buying gasoline, they're not buying new cars, and they're not buying new clothes. Everybody's sitting at home in their sweatpants, waiting this thing out. Then as 2021 and vaccines come online, people start wanting to travel again, wanting to go out again, and we see purchases of transportation and apparel go up, and with that, prices. And you can see transportation, for example, has much higher inflation rates, almost 20%. And if you've been reading in the newspaper, used car prices have gone up substantially. New car prices are up. Gasoline is up. That's kind of being reflected there. Next slide, please. On the flip side, if we look at food and medical services, well, both of those kind of stayed inflationary during the recession. Or during the pandemic. That's kind of what we did. We sat around and made food in our houses and worried about medical things. And then they've kind of stayed at more or less where their historical averages have been. But then we can see at the end of 2021 and the beginning of 2022, food in particular has become, prices have risen quite a bit. Now that's almost 6 or 7% inflation in food. And these are things that we've also been sort of seeing. Next slide, please. Just very briefly, what might be driving this inflation? Well, it's supply and demand typically. So we've seen an increase in demand. People who have been putting off spending during the during COVID have now got money and they want to spend it. And some people have even more money because of stimulus checks or things that sort of helped consumers stay afloat during the pandemic. At the same time, we're seeing a decreasing supply. Transportation backups is being harder to move this much through this many goods through the system, as well as production problems. We're having problems just actually producing some of the goods. And even just this week, the closing of the Ambassador Bridge in Detroit, that was a 2-day affair, was causing production disruptions in car production. That's sort of how thin these margins all are. Next slide, please. So then just last thing, let's just think about now, go back to this inflation and its relation to interest rates through the Fed. Next slide. So going back now, this is the federal funds rate. This is sort of the interest rate, the policy rate that the Fed sets. And I want to just you to note here that the gray vertical bars, those are recessions. So those are times when the economy is not doing so well. And notice those recessions tend to follow increases in the interest rate by the Fed. So this idea that as we increase interest rates, this is a recessionary idea. It tends to put the economy into recessions, and recessions tend to lower prices. And so what we're seeing is typically as the Fed increases interest rates, we see recessions. So then next slide. And now I want to lay the inflation rate just on top of that figure. So look kind of more towards the beginning. I think this is where the pattern is most clear. And notice that the interest rates are rising as inflation is rising. That's the Fed responding to increased inflation. So you can see that sort of chain of events. Inflation rises, the Fed increases interest rates to try to counteract it. The economy tends to go into recession, interest rates fall, and we kind of go from there. Things have become a bit less connected in the last 20 or 30 years, partially because of good maybe because of good management by the Fed, partially because the structure of the economy has changed. But this is sort of where we are today. Okay, next slide. I think I'm finished. Good. So that's kind of where we are now. And I think we're going to turn it over now to our next speaker.
Great. Thank you, Kim. Survey of the landscape. We'll come back to you with some questions. And in particular, I'm going to want to ask you your thoughts on maybe a bit more theoretical question, which is why is 2% the magic number for the Fed? Why couldn't we say it's going to be 3? And so on the backside of this, we don't come all the way back down, or we don't attempt to. So file that away. Next up, we have Mike Stohler, Chief Investment Officer of the Wisconsin Foundation and Alumni Association. Previously, Mike served as the Managing Director of Investments at the Washington University Investment Management Company. And prior to joining them, Mike worked in multi-asset class portfolio management with JP Morgan Private Bank. He holds a PhD in physics from Purdue and an MBA from NYU's Stern School of Business. But he did go to high school in Racine, Wisconsin, which means he has a healthy dose of common sense. Thank you, Mike, for joining us, and the floor is yours.
Thanks, Mike. Really appreciate it. Happy to be here tonight. Good evening, everyone. I appreciate you listening in. Well, I'll try to be somewhat brief so you can tune into the Wisconsin IU game at 8. The legal department would also like me to mention that any specific securities referenced during this session is not an endorsement, and we encourage everybody to talk to a professional about their investments. I should also add that any views expressed here aren't necessarily those of the WFAA. Lastly, I will disclose that I for one, am not a macro pundit and have no particular insight into what the FOMC or Bank of England or ECB are going to be doing. Instead, I thought it might make some sense for me to make some comments about how I'm thinking about the market. In case you haven't been paying attention, there have been some pretty material re-ratings that have happened across stocks and bonds. Bonds are down 3-ish%, and equities are down sort of in the 3 to 10 neighborhood, depending on what we're talking about. For equities specifically, the carnage isn't particularly evident at the index level. However, I would argue that under the surface, there's some pretty interesting things going on. Let's start by winding the clock back to last time I was on the UW Now. It was September of last year, and I had just joined from Washington University in St. Louis. And at that point, there was a lot of conversation about the potential for inflation, but strangely, it was consistently paired with the word transitory, and financial markets really hadn't responded to concerns at that time. And during that session, I talked about how it might be a good idea to revisit and potentially rebalance your growth and value equity investments. At the time, most investors were knee-deep in the concept of an infinite ZIRP, and at the September FOMC meeting, the Fed seemed pretty confident that inflation would normalize to around 2% by the end of 2022. However, as we all know, soon afterward, the narrative started to change pretty substantively. And on November 30, Powell commented that he wanted the word transitory retired. And he mentioned that during a conversation he had with the Senate Banking Committee. Financial markets certainly got the memo at that point. This first slide that they put up, you just saw a few minutes ago. It's the 2-year Treasury yield showing you what's happened since the last time we spoke. There are a number of versions of the next couple of slides floating around, but I find the next two charts helpful in terms of illustrating what financial markets are thinking. So next slide. This first chart shows the Fed funds rate as implied by Treasury futures. The blue line is what markets were thinking on October 1 of last year, and the light blue line is a recent snapshot. This is a pretty dramatic shift in thinking in terms of where rates are going to be and the potential for rate hikes. Before the repricing, the market was anticipating like maybe one hike this year, and now the market is expecting maybe 6 or 7, and many are starting to talk about 50 basis point moves instead of just the standard 25. From an investment perspective, the natural question I would ask would be like, how do we take advantage of this, or at the very least get maximum pass through? Tips tend to come up a lot in conversations that I have. The good news is that tips have done their job. The bad news is that the current market environment is pretty much already priced into tips. So this next chart is the break-even inflation for tips. Think of it as an expected inflation rate that tips are pricing in. Again, the dark blue is what markets were thinking not too long after my last UW Now. The light blue is what today's prices look like. And as you can see, there's a pretty significant adjustment all the way out to 20 years from now. If you want to hedge against inflation being worse than this expectation, then tips might be a useful tool. However, in my view, this train has sort of already left the station. So that being said, what are we thinking and doing in the endowment portfolio? As I've mentioned in the past, a significant amount of the capital that we manage is kind of forever money, where there's a perpetual investment horizon. And as a result of that, we're equity-oriented investors. So the majority of the portfolio is invested in public and private equities. Rate concerns, as we just talked about, have materially but unequally impacted stock prices of select investments. And we're using the current volatility as an opportunity to rebalance into ideas that were probably overpriced coming into the stress. So to bring some of this to life, next slide, the most impacted securities were ones with more distant cash flows. So these are the growth style investments. In other words, we're talking about companies for which the vast majority of the valuation is anchored in the terminal value of cash flows. On this slide, I show the S&P versus Cathie Wood's ARC and a biotech index. And it's easy to make the argument that the majority of the valuation for both of these groups is in the distant future. A changing view of interest rates, the discount rate specifically, has caused a very material re-rate. Another statistic that my old boss, Mike Symbolist at JP Morgan, used today is that the average NASDAQ security is down 42% from its personal peak. It's tough separating the babies from the bathwater. So we're trying to be pretty surgical in terms of what we're leaning into. Rebalancing at an index level isn't really going to work particularly well. And just to beat a dead horse, we'll look at the next slide. So forward one. So I'll illustrate how unequal the recent market leadership. What I did is I took the members of the Russell 3000. So we're talking about both small and large cap securities. And I sorted the return from best to worst between October 1 and recently. And it's a pretty interesting illustration of how the median return, which is a modest negative 5%, completely disguises the behavior of some of the individual securities, where you've got really positive performers and very negative performers on the right-hand side of this page. So on the left hand, you're going to see a lot of oil and gas names, and on the right hand, you'll see a lot of your emerging tech and tech-enabled companies. So on the last page, so forward one more, we show some of the worst performing sub-industries within the S&P, and then note that even within these, in the sub-index level, some of the largest companies have experienced a much worse performance than the indices themselves would imply, thus providing potential opportunities for investors. To be fair, for many companies, valuations are just now coming down to earth, but others have already become, in my opinion, super interesting. And because the endowment was already planning on reallocating some of its public equity, the market volatility is actually a gift that's allowing us to rotate into some new ideas that we like for the long haul, but at more reasonable valuations. Broadly and in summary here, and this call has been wrong many times before, I would make the claim that this environment is a great backdrop for the return of active management.
We always like ending on a happy note. Thank you, Mike. We will go next to Brad Tank, our final guest. Brad's an expert on macroeconomics and monetary policy, and I think is very well situated to kind of put a bow on our presentations tonight that have spanned both kind of the backdrop of inflation and its underpinnings, the Fed's dilemma, and the impact on markets. Brad is an expert on macroeconomics and monetary policy, chief investment officer and managing director of Neuberger Berman, 350 billion, maybe 400 billion by now, asset management operation, as well as the global head of fixed income multi-sector group. He's a member of the firm's operating, investment risk, and asset allocation committees and the investment strategy committee. He brings 38 years of industry experience in a variety of executive leadership positions and mutual fund and other asset management experience. So Brad, great to have you back on the show. Why don't you give us the view that you're adhering to as you interact in the markets every day, and then we'll get to some Q&A.
Sure. I'll make a few comments before we go into Q&A. Thank you, Mike. I've got the easy job. I get to follow two terrific presentations and make a few comments to kind of round things out. I don't have slides, which means I don't have a disclosure statement like Michael did. My legal department thinks I'm having dinner. They have no idea what I'm doing. So if I say anything that leads you to invest in a certain way, I'll give you my own disclaimer. You're on your own. However, Anything I describe in terms of market views, opportunities as I see them, generally reflect how we're investing at Neuberger Berman today. It's many of these views and statements are being applied in active portfolio management. And I too am certainly happy to hear Michael's comment on active management in equities starting to make a real difference. We think that that's something that, as he described, people have talked about on and off for a while, but I'll give you a few reasons why it's likely to stick. And a lot of it has to do with our topic tonight of inflation. The first thing I'm going to touch on, and I was with this group sometime in fall, and I spent some time. I'll do a brief version of what I did last fall, which is the case for inflation not being transitory. A view that we evolved last year as we saw things unfold, and a view that we very much stick with here today. And there are a handful of reasons for why inflation will be sticky on the upside. And in 2021, we hit an inflection point with respect to inflation. The first reason is deglobalization. A big feature of the pandemic was a desire by companies to get their supply chains closer to home and more diversified and more robust. And that's happening in a big way. A friend of mine has a brother who's a commercial real estate broker in Arizona. He's having the biggest year ever. He sold all the land for 2 major chip plants being built in Arizona from offshore manufacturers, 2 giant fab plants. That's just one example, and it's happening in industry after industry. And it's a long-term trend. Companies and industries are less interested in lowest cost and more interested at the margin. Low costs still matter, certainly, but more interested at the margin in robustness of supply chains, and that's influencing CapEx. And at the end of the day, lower cost strategies don't always rule. That's going to be something with us. That's going to be with us for a while. Very much related to that is China. China's been a source of deflation, disinflation since they entered the World Trade Organization in the late 1990s. And there's been a radical change in the demographics of China. Their process of urbanizing the country and the economy is largely complete. It's slowing down quite dramatically. People moving from country to city means that jobs have to be found for those folks. And that process is largely over. The last census in China, completed 2 years ago, surprised many economists at how quickly that urbanization process had unfolded. And then we're all aware of the demographic time bomb of a rapidly aging population due to a single child policy that had been in place for years. So their workforce is shrinking against a backdrop unlike anything we've seen before in terms of that economy. So they are internalizing that economy. They will still be a major export engine to the world, but their process and policies for managing that economy are changing and changing rapidly, and they will not be the force for deflation, disinflation that they have been for the last generation. Third reason why inflation is going to be persistent going forward is decarbonization. It's something all reasonable people believe in. At least most reasonable people believe in. It's generally a process that has just started to unfold. It's a process that it certainly has a lot of support from many quarters, but it's not going to be a painless process. And it's a big change. It's a big inflection point because non-carbon sources of energy on average cost quite a bit more than carbon sources of energy. Unless there's some major technological breakthrough, this process of decarbonization is going to change the trajectory of a major input in not only manufacturing, but services in many, many industries. And this is something that it's a big change. Energy inputs have been going down since the transition from whale oil to petroleum. And we are now looking at an environment here over the next generation where on average, the cost of energy inputs is going to go up. We've seen it in certain economies like Germany already, and hopefully the United States and other economies can manage the process a little bit better than Germany has. Their energy costs are roughly double what they are in the United States, and it's having an impact on German manufacturing. So fiscal and monetary policy is the last thing, And I'll, without getting in any detail there, I'll just simply describe the process of central banking, at least in the developed economies. It's less true, interestingly enough, in the developing economies or emerging market economies, but in the developed economies, the Eurozone, Japan, and certainly the US, central banks have become more politicized. It's a slow creep. There's a strong desire on the part of this central bank to not disrupt the economy and the financial markets as they begin to tighten financial conditions. It's going to be a very interesting year to watch his central bank operate and the European Central Bank operate, who seems to be on a very similar path. So things I didn't mention that are transitional, a big chunk of the supply chain disruptions ultimately will work out. They're permanent aspects, and then there are aspects that are going to dissipate. But it's going to be a very uneven process because we all know that there are certain industries that are continue to suffer from part shortages and supply chain disruptions. The best example relates to something that Kim mentioned in his presentation, which is the cost of cars, new cars, used cars. Used cars are going up because you can't buy new cars. And you can't buy new cars because of part shortages, principally semiconductors. But interestingly enough, if you look at the macro, if you look at the U.S. economy, we had a record quarter in fourth quarter 2021 in terms of growth, nominal growth. Haven't seen it in years. The interesting thing is a big contributor to Q4 growth in 2021 was an inventory build. So at the macro level in the U.S. economy, you've got an inventory build going on, while at the same time at the micro level, company and industry, you still have shortages. Very disruptive. It makes it very challenging for companies to manage costs and manage their margins in certain industries. So some of it's going to go away, some of it won't. But this inventory build in the face of continued shortages is causing a little bit of alarm on the part of economic forecasters. I haven't mentioned wage increases, and wage increases have been robust. You've got wages, depending on how you measure them, in the U.S. rising at north of 5%. We haven't seen it in a long, long time. Ultimately, our view is that's going to dissipate as well. I think the labor force is going to start to grow much as it did slowly over the course of years, as it did post great financial crisis. We'll see the same thing. There are a lot of reasons why people haven't returned to work, even as the pandemic winds down. But wage inflation is a problem now. We think it ultimately will be transitory. And then you've got rents. Rents have exploded. New York City rents are up 30%. And so, again, ultimately you'll bring supply on, but it's going to take time. It'll take construction. It'll take a while for that to dissipate, but it's a handful of reasons for specifically why inflation is going to be around for a while. And what we've gotten used to over the course of the last two generations, 40 years, Michael had a slide up. I think it was Michael or maybe Kim had a slide up going back to 1970, where you saw the trajectory of inflation. It spiked from 70 to 80, and from 80 to the present, it's been coming down, and it's been coming down in two phases. First, the disinflation phase that ran from really about 1980 to around 2000, where inflation was high. It averaged above 3%, but it was on a downward trajectory. And then from that point on, for the last 20 years, inflation has averaged below 3%, well below 3%, below 2% for the last 10 years. We broadly describe that from a U.S. central bank standpoint as being 30 years of fighting inflation and 10 years of fighting deflation. That's what the U.S. central bank's been challenged with, and it's been mirrored to some extent by what's been happening in Europe as well. Japan, interestingly enough, entered a disinflationary phase earlier and has been fighting deflation for much longer, and it served to some extent as a roadmap for what we've seen over the course of the last 10 years in Europe and the U.S. So from here, if inflation, as we forecast, proves to be sticky, proves to be persistent, we're moving higher. This is a big inflection point in terms of what we've all gotten used to. It's a big change based on what we've seen over the last 40 years. Michael talked about the impact on stock prices, and we've certainly seen it. It's been a turbulent year so far in 2022. Our view at Neuberger Berman is it's going to continue to be a turbulent year. It's You're seeing it in markets even beyond equity markets. Annualized volatility in the high yield market year to date is about 11%, which is very, very high for a bond market. You're seeing it all over the place, and the big source of this volatility, of course, is uncertainty and rapid changes in projections for central bank policy, and of course, it all harkens back to this big rise that we've seen in inflation. Sticking with equities as a topic here for a moment, there's really three sources of risk that comes from inflation in equity markets, and Michael hit on it a bit. I'll elaborate a little more. There's the simple fact that rising interest rates requires one to discount cash flows at higher rates and reduces the value of those cash flows out in time. It yields lower values if you're using higher rates to discount future cash flows. And it's been particularly acute in certain parts of the equity market that Michael showed us, namely aggressive growth stocks, where their cash flows are very long duration. They're way out in time. Many of these companies have no cash flow today, but the belief is they're going to have very big cash flows 10, 20, or 30 years hence. And so those types of stocks are very, very sensitive to changes in interest rates. There's other factors at work, like how stocks react nominal rates versus real rates, but we don't really have to get into that. Suffice it to say that rising rates, it's hardest on any asset that has cash flows out further in time. And that holds for stocks as well as bonds or real estate or other things as well. It also a function of where's your cash flow coming. Second macro factor is won't get in any depth here. It's correlations. How risk-free assets like treasury bonds trade relative to stocks. And we've lived in two regimes here in Europe and the United States over the last 40 years. The first regime, that is consistent with what I described as the disinflation regime from 80 to 2000, roughly, was an environment where inflation was coming down, but was still sufficiently high that the correlation between treasury bonds and stocks in price was positive. And that meant that if you owned a portfolio of stocks and bonds during that period of time, it was a lot more volatile than a stock and high quality bond portfolio has been for the last 20 years. What we've seen post 2000 in a low inflation regime is the correlation between treasury bond prices and stocks has been negative. And we've seen it time and time again. Think about the financial crisis. 10-year notes go from north of 2% to well under 50 basis points. I think the 10-year note got down to 29 basis points as stocks cratered, which meant the bond prices went up dramatically, even though equity prices were going down. That's been a normal relationship for 20 years, in large part because inflation's been low. Our belief, and this is a partial answer to why is 2 magical rather than 3, inflation persistent above 3% suggests that the stock bond correlation moves from negative price to maybe neutral or indifferent to positive price. And that introduces a lot more risk into capital markets, something we haven't seen in 20 years. So that's a second source. It's not really at play at the moment, although correlations are moving from negative to positive on a short-term basis, but it's something to watch as we work our way through 2022 and beyond. And then the last factor, and this is something that Michael talked about that's really important, which leads him to conclude, and myself and my colleagues to conclude as well, that stock picking is really going to be important now, is that the micro effect of inflation is pretty dramatic when you look at how it affects industries and different companies. And that suggests a whole set of investment strategies that we could get into a lot of detail on where you want to be in a higher inflation regime. I can encapsulate it pretty simply by saying buy stocks, bonds, or investments where the cash flows are closer rather than further out in time. So that suggests things like value stocks versus growth stocks. It suggests companies that have pricing power. And here's another challenge for the Fed. In the midst of the pandemic, less than 1/4 of companies reported that they had pricing power. 1,000 companies surveyed by one of the regional Federal Reserve banks, less than 1/4. Today, that number stands at 55%. We've seen a dramatic lift in companies that feel like they have pricing power, and we've seen that number rise to levels we haven't seen in years and years and years. So the key to stock selection in this environment is to find companies that have pricing power, that can benefit from inflation rather than suffer from inflation. Some industries, like various commodity industries, energy's been a big winner this year. Energy prices have come a lot. That's not necessarily a no-brainer from here, but even within industries, many companies are more well poised to benefit from inflation. Some are going to suffer. I'd say as a general theme, you want to stay away from companies that have to face off directly against the consumer. U.S. consumer, European consumer, very well trained in finding the lowest prices and making sure that they get the best possible deal. You're better off being an upstream manufacturer, service provider, or maybe a midstream manufacturer, service provider, rather than directly facing the consumer. And you saw that in Michael's chart, where he had some of the industry groups relative to the S&P that have fared the poorest so far this year. Media and telecom, they face the consumer. Consumer products obviously face the consumer. So in fixed income, it means staying short floating rate product like bank loans, short duration bond portfolios, and the like. I'll stop there. So we've got some time for Q&A.
Brad, we'll cover for you with compliance. This was a good dinner. Thank you. So I'm going to stick with you for a minute, Brad, and ask you, the last time you were on, it was just days after Powell's testimony when he reversed course and walked away from the term transitory. Do you think Powell has actually done, I know at the time you said that's the difference between being in the interview and having the job. I think he was just appointed, and that's when he came out and said, not transitory, permanent. Another way to look at that, though, is Powell's really done a good job of managing inflation expectations, which is important to keeping actual inflation down. For as long as possible, arguably, he said it's temporary. Then when that became untenable, he said, well, maybe it's not temporary, but we're going to kill it. And, that's actually really helpful, in my opinion, in keeping inflation down. Would you give Powell good marks for how he's performed and handled the situation?
So far, I think you have to. You make a very important point, which people that are overly critical of the central bank haven't really focused on that much, which is, inflation's gone up a lot. It's shocked everybody, even the most pessimistic forecasters on the high side. And we haven't seen the worst of it. We saw January CPI year on year was 7.5, and February is probably a higher number. Probably won't peak till April or May. So it's going to keep going up. And then by the time you get to April, May, your year-on-year comparisons get better. So the headlines aren't going to look good for a while. But against that backdrop, inflation expectations have not gone up that much. And a long-dated tips market, we saw some good slides earlier, hasn't risen all that much. It's nowhere near where headline inflation is. It's got a long way to go. So inflation's expectations still remain under control, which means that confidence in the central bank remains high. So they have not lost the confidence of the market, importantly, but the consumer as well. There was a report out of the New York Fed yesterday where inflation expectations actually went down. Nobody can quite explain that with headline inflation going up. A survey of respondents, New York Fed, big drop in inflation expectations. So there's a belief that some of this, at least, will be transitory, and this is not going to last. And so the key, I think, for Powell and the Fed going forward is they've got to bring it down. They've got to get this thing on a downward trajectory. They're going to implement, according to the market right now, 6 rate hikes this year. And they'll probably take what the market gives them. And by that, I mean in the next meeting coming up in March, the market's moving toward a 50 basis point move. Our view is we don't think they're going to do 50. They'll start with 25. They want to start gently. But you never know. If the market gives him 50, he might take 50. I think it's a harder call. We're still sticking with our 25 on the first one. But then they're going to signal that they're just going to go. And right now the market's talking about moves at almost every meeting this year. And it's likely, unless you see something on the growth front that interrupts the confidence that Powell and the bank has with respect to growth. And the big narrative on growth coming into this year was We just came through a recession, and you saw it on Kim's slide, very narrow band, which was the recession during the pandemic. Quickest ever. Was steep, but man, it was fast. And again, that was central bank quick response. I think most people give Powell and the Fed excellent job that period of time. But now to some extent, they're paying the price for this. But from here, they're just going to have to deliver. Now, what might be a surprise on the growth front? Because that recession was so fast, there was so much fiscal stimulus, there was so much support for consumers and businesses, wide variety of programs. Wallets were out, not just in the US, fiscal, Europe, other places. Consumer came through in great shape in terms of consumer balance sheet, consumer debt, consumer savings. Importantly, financial institutions, no big lift in defaults, delinquencies, problems, no bank downgrades. So your financial sector's in great shape. Your consumer balance sheets are in great shape. You typically don't have recessions when that happens, which leads a lot of people to conclude it's mid-cycle. But if inflation stays really sticky, we're printing 5%, 6% type inflation numbers in the second half. How's the consumer going to behave to that? That's the big, inflation is the biggest growth risk. It's not balance sheet. It's not financial institutions. It's how's the consumer going to behave relative to persistent inflation. So that's why the Fed's got a sense of urgency. They have to bring it down. We're going to have to see some progress in the second half. And if you think these inflation numbers are interesting and lead to volatility, wait for the second half because those numbers actually are more important. That's when the forecast is we're going to see some relief. The numbers are going to come down, and we've got to be on some kind of glide path that gets us in the trajectory of 3%.
All right, so Powell had to move away from saying it's temporary to saying we're going to kill it. But I'm going to say right now, I think it's irresponsible to think that massive rate hikes are the right way to fix inflation when so much of it is in the supply chain, logistics, all kinds of stuff that's screwed up because of some of the lockdowns and just, people not being able to go to work, the disruption of the global supply chain, as you mentioned, as people kind of peel back and go more domestic. The labor force participation is off. None of that gets fixed by a rate hike. So why do we really think the Fed should be that aggressive? I mean, I get we've got to move in March and we probably need to make a few more moves, but this idea that they're going to hike rates 7 times, I still find to be a little odd. And I think it would be very unhealthy if we thought that was fixing the root cause.
Yeah, as I said, Mike, we're at 25 on the first move, and our forecast we're at 4 hikes this year, and we think the path of being measured, they're going to go, and they've got a good trajectory laid out. We'll know more next month, but I don't think they're going to panic and start to get overly aggressive. I think the market's priced in, at least for 2022, the max. We priced in the maximum that they're going to do, and on all likelihood, we see some hiccups in the markets. We see some hiccups in consumer behavior. They may back off the gas a little bit.
Got it. Well, I guess like minds think alike. I'll say that. Kim, I promised I would ask you, from your perspective, why should the Fed stick with 2% as kind of the holy grail? Like that's the inflation target. Why not acknowledge, hey, we've had this pandemic, things got kind of upended. We're going to settle in at 3% because, what's the difference as long as it's consistent?
Yeah, so let me start with your last kind of throwaway comment there, which is, should it matter as long as it's consistent? And that's in some sense the biggest point of having a target is, what we really want is for inflation to be predictable. Right? So the number one thing is we want people to kind of understand at what sort of rate they should expect prices to increase, which in some sense is at what rate they expect, the value of their dollar to decrease. And that helps people, consumers and businesses make long-term plans, right? The volatility in the inflation rate is probably the biggest thing to worry about. In particular, we think about a surprise inflation. So one that wasn't kind of predicted, for example, maybe like what we're going through right now. Great for people who have debt. I have a mortgage. The nominal interest rate, stays the same. A fixed rate mortgage, inflation just makes the real rate on my mortgage cheaper. Obviously, people who lent me that money are getting a lower rate of return, and it's bad for them. And it's vice versa with the surprise deflation. Right? It just so kind of consistency is probably the most important thing. How do we get to 2%? Yeah, so part of that, kind of has to do with historically the way the real economy has grown, the ability to produce more goods and services. And so, if that's growing at 2 or 3%, then a 2% inflation rate gets you to a nominal interest rate of somewhere around 4 or 5%, which kind of through the 90s and, kind of seemed like sort of the right number. Inflation that was sort of stable at that point. And that kind of worked. Now, what you might want to think about is, and there was a big kind of discussion about this in 2008 during the last recession, was maybe that kind of long run growth rate, real growth rate has fallen. Maybe the economies just aren't going to grow as fast as they have in the past. I think Brad touched on stuff about, the switch from carbon to non-carbon fuels, and kind of that's just going to be more expensive and make everything a little harder to do. Other things have happened since then. Has the rate of technological progress changed? And if that's the case, then there might be an argument for a higher, I don't know how much higher, but a slightly higher kind of target rate. I think it's worth noting that 2% is almost universally adopted across the world. Again, I think some of that has to do with real rates of growth, and a lot of countries hovered around the same rates, and so central banks kind of naturally kind of fell to those things. And as long as things are kind of consistent and predictable, and I think Greenspan once said something like 2% or some kind of number like that. I want it to be a number that people don't have to think about it every day. That 2% is sort of a low enough number that it's not something that kind of people can naturally sort of adjust to without having to think about it. You could imagine if the inflation rate was predictably 50% a year, even though it's predictable, it would still be something that people had to sort of worry about, kind of making a mistake, let's say, around. And so that's kind of, I think, how we've gotten to this. The other upside is that a slightly higher, especially if we think real interest rates are lower, a slightly higher inflation rate gives the Fed a bit more room to maneuver, in the sense that they can't, at least as of now, can't set nominal interest rates below zero, or at least not for very long. And so that's a second kind of benefit that you might see. So you might see someone at some point start to make a case for a higher target inflation rate. And again, as Brad pointed out, the Fed has been below 2% for most of the 2000s. So on average, maybe we're getting close to 2%. But again, we don't want to see the volatility that we're kind of seeing, kind of right now.
I'll come back to that volatility, but I want to stay with you for a minute, Kim, and ask you a question from Tammy Olson. How frequently does the Bureau of Labor Statistics change the market basket, and even where shoppers are buying their goods, because that's changed dramatically? How do they keep up with trends in the consumer marketplace to really measure inflation?
So they keep up with it through extensive journals and surveys, basically. So they go out and ask thousands of consumers in the United States, and they go to thousands of two pieces. You ask a bunch of consumers what they spend their money on. So you go to thousands of people and say, in the last 2 weeks, tell me about what you spent money on. And so that's going to pick up changes in expenditure, kind of patterns. It could be that we spend a lot more money now on electronics than we did, or more money on digital services than we did 20 years ago. And so we want to pick up those expenditure patterns. Those surveys, for the data that we're using right now, the CPI, those surveys were taking place in like 2018, 2019 or so. So every few years, we're kind of, this stuff all comes with a lag. So the data today are coming from surveys from a few years ago. And then the second piece you sort of mentioned is the actual price observations. And so you can imagine what we do is go out and gather price data from individual locations. So go to stores and look for a very specific item. I want this 1 pound bag of rice, white rice, this particular quality, maybe even this brand, and try to price that through different places in the United States. And that helps us come up with comparable measures, both across geographies, but then, across maybe different groups in terms of like urban consumers versus non-urban consumers. So there's a whole army of people who are working on trying to keep our measures of inflation representative, but it's also but it's an imperfect science, and there's measurement error in these things. And again, that's maybe also part of why you might want a positive inflation target rather than say a zero inflation target, because these are imprecise kind of measurements, and any 1 month's inflation data should be taken with a grain of salt. But we've now seen several months of inflation data suggesting that inflation is high and rising. And I think that's partially why we're seeing the Fed kind of have to sort of take this maybe as a little more seriously than they have in the past.
Thank you, Kim. I don't think anyone works harder to get things right than the BLS, based on everything I know. They do a terrific job with complex problems. Well, except maybe one place, and that's the WFAA endowment management. Mike Stohler works hard to get things right now. Question for you. You talked about managing a perpetuity fund earlier, and I just want to make sure our audience understands. It doesn't sound like the team is making some kind of in-house macro call that, hey, we think the market's, at a peak now, so we're going to sell off from equities and sit in cash and then buy back in when it goes down. We're kind of fully invested pretty close to our normal mix at all times and try to rotate. Is that what I'm hearing from you?
That is a pretty fair characterization, Mike. We're hovering pretty close to neutral weight. If you look at our overall equity allocation, where we're summing together private and public investments, at the end of the day, are rates going up? Absolutely. Are they going to be nauseatingly high, in the near to midterm? Probably not. And even growth equity investments are going to survive this. Remember, we're coming off of a period where those growth investments were probably incredibly well capitalized. So balance sheets are actually in pretty good condition here. So we feel like, where we're given the opportunity, we can lean into some really interesting ideas while kind of maintaining a neutral weight. Now, if we get a 50 basis point hike in March, right, to really kick off this year in style, and the market throws up on that, it's possible we'll go overweight, and try to really take advantage of some stuff that comes our way.
So I think in a nutshell, what you're saying is when you showed all that dispersion in how different types of stocks, growth versus say value, as Brad mentioned, have responded to recent news, you're saying that based on the tips market and other indicators, you think over a reasonable period of time, interest rates are going to get back relatively close to where they were, maybe not as low as they had been, and that this reaction was maybe inconsistent with what you're seeing in the tips market and our expectations of the Fed.
Yeah, well, there's a couple of crosswinds here, right? Like valuations were, in some cases inappropriate coming into this. So there's some air coming out of the tires here that I think is incredibly healthy. And that's obviously not a reason to buy. So it's looking among, the investments of that profile and actually finding some hidden gems is where things get interesting for me.
Good. Well, there's a Badger game tonight, and I've tried to signal that with my attire this evening. I have one question, two questions to finish on. I want you to each tell me, a year from now, what's the year-on-year inflation rate going to be? Brad Tank?
Yeah, year-on-year, a year from now, I'm going to say it's 4%.
Mike Stohler?
Yeah, I'm going to say sub 3 on this. 2 to 3.
Kim Ruhl?
The Fed thinks it's going to be sub 3 if you look at their forecasts. So I'm not going to argue with the people who set these policies. By the way, they also think the long run rate is still going to be 2%. So the people with their hands on the lever, they think it's going to be 2% in the long run, and presumably they're going to do whatever they can to make that happen.
And then Tim Carr wondered, how high do you think inflation will go before we, as we cycle through that? Brad, just you give me your thought on that. What's it going to peak out at in April?
Yeah, I think next month probably shapes up to be a little bit higher than this month, so call it 7.7. And then depending on the mix was kind of frightening in January. Every single category was up, and depending on how the next month goes, it
so
could go up again. But it's somewhere between 7.5 and 8. PPI service inflation just printed this week at 8%. So, I think we're going up before we go down.
Badgers, Indiana. Kim Ruhl?
Badgers win.
Mike Stohler.
Got to go with the Badgers on this one, Mike.
Brad.
That's it.
You're value investors. I like it. We've got a value team, don't we?
That's the consensus bet.
All right. Well, enjoy the game. Thanks for taking time to share your insights with us again. Really appreciate it. And have a great evening, everybody.
Thank you.
Good night, everybody.
Thanks for joining the live stream again tonight. It's a pleasure to be with you. I hope you enjoy the Badger game. Go cheer the team on to victory. We'll be back on March 12th on Wisconsin.
You can try, but you'll never stop a Badger. Because we Badgers are born with curious minds and endless heart. When we see a curve in the road, we speed up. When there are mask shortages for first responders, we make our own supply chain. When there's a world on pause, we sharpen our claws. Through thunder, fire, and pandemics, we'll keep going. Because after all, you can't stop a Badger.